We actually think that the environment is relatively similar today to the environment that we found in 2004. Obviously, we're starting after a higher base. We have higher earnings today. We have higher asset bases today, but the macroeconomic environment is not that dissimilar. In 2004, we were right at the start of an interest rate cycle, and actually between 2004 and 2006, short-term interest rates have been hiked 14 times, and that was a very, very good period for utility investing. Actually, utilities outperformed substantially over that period. And if you think of it, that makes a lot of sense, because interest rates go up when there's a little bit of inflation in the system, and modest inflation is very good for utilities because it allows them to raise tariffs. It means that electricity prices are gradually going up and that the revenues of utilities are gradually growing. At the same time, long-term interest rates were low and have stayed low. So in technical terms, that means that the interest rate curve is very flat, and the long term being relatively low is also very good for utilities because utilities finance themselves at long-term costs. So it means that the cost of financing is low and contained, whereas in the short term the revenues are growing. So that's an environment where your cash flows are growing and where dividends can grow substantially over the course of multiple years. So today we think that we are in a similar environment to 2004. Where are we maybe a little bit different is on the price of commodities. In 2004, we were in a period where gas prices and oil prices were very high. Today, we're in an environment where gas and oil prices are relatively low. So that does mean that within the sector, we might need to choose slightly different names. But for the overall sector as a whole, we think that the economic backdrop is very healthy. Well, we think that monetary tightening is not necessarily a bad thing. As I already mentioned, in previous rate cycles, like the one 2004 to 2006, utilities did well. And the main conditioning there is that the monetary tightening needs to be gradual and cannot have an impact on long-term rates. If long-term rates go through the roof, then that is negative for all equities, utilities equities included, because it means that the cost of financing becomes much higher. Now, typically the way this works is long-term rates go up substantially if the market thinks that central banks have lost control of the economic cycle. And so monetary banks stepping up gradually and raising short-term rates gradually shows that they are staying in control, that they want to contain longer-term inflation and just let it grow gradually. And that's a very healthy rate cycle environment. So we think that the US central banks gradually raising rates, and maybe European central banks with 6 or 9 months delay also doing something similar, is a very healthy environment. We also think that long-term rates will stay low for a very long time, and that is more linked to demographics. The world population gradually growing older is something that contains longer-term inflation and longer-term growth. Also the fact that the overall economy is very indebted. Levels of debt around the world in families, in corporations and for governments are elevated, and that's also something which depresses long-term rates. That is something that is very good for utility investors. Well, we don't think there's a lot of surprises there. We think that the positive factors going forward are the same ones that we've seen over the last decade. These are sectors that grow slowly but very steadily. And the growth is really driven by new projects. And if we look at our investment universe, we find the need for new projects everywhere. If you think about utilities, it's all about replacing oil and gas and coal, very polluting technologies, taking those out and replacing them by technologies like wind energy or solar energy. And so those are new projects, and that is driving investments, and then investments in their turn drive new cash flows. If you think about the communications infrastructure, it's all about preparing for 5G. And 5G requires better networks, more antennas, more fiber. And I think in Japan, NTT is actually at the forefront of that phenomenon. So that's a steady source of incremental investment that drives incremental growth. If you think about transportation, it's all about creating better highways, better railroads, better airports. It's the one belt, one road phenomenon in China. In the US, there's a big need to replace old infrastructure. On the water infrastructure side, a lot of pipes need to be renewed because they are 50 years old or even worse. So that's a steady upgrade cycle. So what that means for our companies is that this isn't a big shock. This is just a steady process of investing day after day, week after week, and this is growing their balance sheets steadily, and because of that the cash flows keep on growing and the potential to pay dividends keeps on growing. Well, obviously it's a difficult question for us because if you think of Gloin as a portfolio, there are about 70 stocks in Gloin and we actually think they're all very attractive. So if we just have to think about picking one, we have very interesting emerging market names. We have very interesting US names. So I'm just going to pick one US name because it groups several drivers. The name would be Next Era Energy. This is a US electrical utility company, but it's a very good combination of two drivers that I've already talked about. Next Era has about 65% of its revenues coming from regulated utility activities. They are the number one utility in Florida. Florida is a state which is growing at about 2 or 3% per year because of population growth in Florida. And it's a very good regulator with a regulatory environment that allows them to generate a 10.5% return on investment. So that part of the business is just steadily growing by about 2 to 3% per year. Nothing spectacular, but very defensive, very predictable type of growth. On top of that, there's about 35% of their business which is really focused on renewables. And this is across the United States. Next Era has been one of the first to realize that this need to replace old polluting technologies by renewable technologies was going to be a big driver for investment. So they have been adding projects across the United States. They are building wind farms in the desert, they are building solar panels, and they're connecting those to all the major cities and to their grid. This is an activity that is growing double digit over the course of the years. It comes with slightly higher risk because you're building new types of infrastructure, but they have been very early in this process and they've been able to find the best types of opportunities. So if you combine these two, 65% of the business which grows slowly but very predictably, and then another component that shows much more attractive growth, you combine these two, it means that Next Era as a whole is probably going to grow close to double digit for the next 3 to 4 years. The business pays today a dividend yield which is about 3%, and that's maybe towards the lower end of the companies that we typically pick, but that dividend is growing double digit for the next 5 years. So if you think of the next couple of years, you're going to have a very healthy growth engine coupled with a very defensive income stock. This stock has already performed relatively well, but we see no reason why this wouldn't continue to be the case for the next 5 years. Well, my message in a couple of minutes would be that investing in global infrastructure, which is what Gloin does, is actually an ideal way to benefit from global economic growth, but to do that in a very low risk type of environment, because everything that we invest in gives us very high levels of visibility and very high degrees of safety and of predictability. And today we live in a world where there's a lot of exciting things going on, things about the internet, about biotechnology, but these things are very difficult to predict and they are very volatile in nature. We think that the way we invest allows us to have a very low risk type of equity investment, but a type of equity investment that benefits from global economic growth in all regions of the world. And then on top of that, we have a team of very dedicated people here in Geneva that are there to focus on picking the best companies. We have a universe of several hundreds of opportunities, and we always select the 60, 70 best opportunities out of these several 100s around the world. And we would thank you also very much for the confidence that you've given us in the past years. And we're very excited to keep on doing this for our very stable investors.